Welcome to this deep dive. Today, we're jumping into a really fascinating moment in business history, a true strategic crossroads.
Yeah, we're looking at Nucor Corporation back in December 1986.
Right, and they were staring down this huge decision whether to pour $340 million, which was practically their entire net worth, into a brand new, unproven technology called thin slab casting.
It really was a classic bet the company situation.
Yeah.
A massive gamble, but the potential prize was enormous, cracking the flat sheet steel market.
And Nucor wasn't some struggling company needing a lifeline, were they?
Not at all. By 86, they were already a known disruptor, a very successful mini-mill, super efficient at melting scrap, and they'd grown by cleverly undercutting the big traditional steelmakers in certain product areas.
They also had this pretty unique company culture, didn't they?
Oh, absolutely. Very flat management structure, lots of decision-making power at the plant level, and these really powerful bonus systems tied directly to performance. Very different from the old guard.
So here's this successful, agile company eyeing this massive market flat sheet steel, like half the entire U.S. steel demand. But the only way in, it seemed, was this unproven compact strip production, or CSP, tech from a German company, SMS.
And that's the core dilemma, isn't it? This huge opportunity versus, well, enormous financial and technological risk, because CSP had zero commercial track record, none.
Plus, other similar technologies were bubbling up too, right? So there was a risk of picking the wrong horse or maybe getting leapfrogged later.
Exactly. So today we're going to unpack this. We'll look at the state of the U.S. steel market back then, Nucor's specific position, what this thin slab tech actually was, and, the logic behind the incredibly tough decision Ken Iverson, Nucor's CEO, had to make.
Sounds like a great case study in bold strategy and high-stakes innovation. So let's set the scene. What did the U.S. steel market actually look like in 1986?
Well, connecting it to the bigger picture, the mid-'80s steel market in the U.S. was challenging, to say the least.
Challenging how?
Since the late 70s, domestic shipments and overall demand had dropped quite a bit, maybe around 30% since '79.
Wow, that's significant. Why the decline?
A few things were hitting it at once. Key industries that use a lot of steel, like autos, were stagnating. Plus, companies were getting better at using steel more efficiently, needing less of it. And of course, substitute materials like aluminum and plastics were making inroads.
So a shrinking pie overall.
Yeah, though the general feeling at the time was that it probably wouldn't shrink much more in the immediate future, maybe bottoming out, stabilizing a bit.
Okay, so a tough market, maybe stabilizing. And it wasn't just one type of steel, right? It was segmented.
Precisely. You had your semi-finished stuff that needed more work, then the big one, flat-rolled products. That includes plates, and especially sheet and strip.
That's the segment Nucor was eyeing.
Exactly. Flat-rolled was the giant, roughly half of all domestic steel shipments. The rest was things like bars, wire rods, structural shapes, pipes, tubes, all serving different needs.
And within flat sheet, who were the big customers?
Three main groups drove about three-quarters of the demand. First, service centers and distributors. They were becoming really important.
What do they do?
They often buy the basic hot-rolled sheet, then process it further for various end users. Then you had the automotive industry, a huge consumer. And third, manufacturers of appliances and equipment. Construction was also a significant buyer.
And different customers wanted different types of flat sheet.
Generally, yes. Service centers often focused on hot-rolled. Autos and appliances increasingly needed the higher-value cold-rolled and coated sheets for better finishes and properties.
So what did buyers care most about when choosing a supplier? Price, obviously.
Price was huge, definitely. U.S. steelmakers, especially the integrated ones, had hurt themselves with uncompetitive pricing against imports. Quality was critical, too.
Quality meaning.
Things like internal strength, surface finish, consistency from one shipment to the next. And finally, dependable delivery. Big manufacturers needed reliable supply chains.
So price, quality, reliability.
Got it. Now, you mentioned different types of producers. Let's break that down. There were three main groups.
That's right. First, the dominant players, the integrated firms.
The big guys, starting from iron ore.
Exactly. Huge plants, blast furnaces, the works. Think U.S. Steel. Their combined capacity was massive, around 107 million tons in '86. Historically, they were the stable oligopoly, dominant after World War II.
Okay, the incumbents,
Yeah.
then the mini-mills. like
No,
Nucor.
correct. Minimills emerged really in the 60s. They used electric arc furnaces to melt scrap steel, much smaller total capacity, about 21 million tons back then.
And their strategy was different.
Totally. Lower costs, often focused on simpler low-end structural products initially. They served regional markets, built plants faster. But by 86, they were expanding, competing more fiercely even amongst themselves.
And the third group.
Specialty steelmakers. Smaller capacity, maybe 5 million tons total. Focused on things like stainless steel, other special grades for niche applications. Okay, so the integrated firms still had the bulk of the capacity, but the minimills were clearly rising and shaking things up. What were the big problems facing those integrated giants? Sounds like they were struggling.
Oh, they absolutely were. It was a perfect storm, really. A key issue was their slowness in adopting new, more efficient technologies.
Like what?
Well, they were slow on the uptake with the basic oxygen furnace, which drastically cut steelmaking time compared to the older open hearth method, and they lagged behind on continuous casting, too.
Continuous casting. That bypasses some steps, saves energy.
Yeah, it cut manufacturing costs by like 15% by eliminating ingot pouring and reheating, but adoption was slow. Interestingly, some customers were even resistant initially.
Resistant to cheaper, better steel? Seems odd.
Well, change is hard, right? Existing relationships, maybe worries about consistency from new processes, but this tech lag really hurt them, especially as imports were getting cheaper and better quality.
Imports were a big factor then.
Huge. And the integrated's modernization efforts were often inefficient. Sometimes they spread money too thin across old plants, face high energy costs, just couldn't catch up effectively.
And what about labor? That's always a big topic in steel.
Absolutely crucial. Union contracts meant significantly higher compensation compared to other manufacturing, and work rules were often rigid, making it hard to innovate or change job functions efficiently.
So high labor costs, inflexible rules.
Right. Add in layers of bureaucracy slowing down decisions and rising debt that made big investments harder. They did try restructuring in the late 70s and 80s, cut capacity, shed jobs, improved productivity somewhat, but the fundamental cost disadvantages remained.
We're talking serious financial trouble.
Billions in losses across the major integrated firms during that period. It was grim.
You mentioned the big three were USX, LTV, and Bethlehem. What was their specific status around 86?
Each was facing its own crisis, really. U.S. Steel had diversified into energy and renamed itself USX, but they were actually in the middle of a major strike in 86. LTV Steel, formed from mergers, actually filed for Chapter 11 bankruptcy in July 86. That tells you how bad things were.
Wow, bankruptcy.
And Bethlehem Steel was trying to refocus on steel, modernizing, but racking up significant debt in the process. If you look at their numbers from 86, capacity use, continuous casting rates, bottom line losses, debt levels, it paints a really stark picture of an industry segment under immense pressure.
Definitely a tough environment for the old guard. So let's flip back to the minimills, the disruptors. What was their magic? How did they rise so effectively?
Their whole model was different. Electric arc furnaces, melting scrap steel. That's a fundamentally cheaper starting point than iron ore.
Lower raw material cost.
And lower capital cost to build the plants, faster construction times too. Initially, they smartly targeted those lower-end structural products that the integrateds were perhaps less focused on, or where scrap availability was good.
And they located plants differently.
Yeah, often regionally,
Right.
closer to scrap sources and customers, sometimes in areas with cheaper power. So you had advantages in technology, location, labor costs, which were generally lower, and non-union or with different structures, leaner management, and a more focused product range. It let them chip away market share consistently.
And Nucor was at the forefront of this. Tell us a bit about their origin story.
It's a great story. They actually started way back as a car company, Rio Motor Car, then became Nuclear Corporation of America, doing various things. It wasn't until Ken Iverson took the helm in '65 that things really shifted.
Be focus things.
Big time. Sold off unrelated businesses, really doubled down on their profitable steel joist division, Volcraft, and then came that first big bet, deciding in the late '60s to build their own minimill in Darlington, South Carolina.
Why?
Because Iverson figured they could make the steel bars for their joists cheaper themselves than buying them. That Darlington decision was kind of the blueprint for their later boldness, wasn't it?
Seems like it. This risk-taking DNA. What were those key Nucor principles in 86 that made them tick?
It was a really distinctive management philosophy. Super flat structure, like 5 layers of management versus maybe 12 or more at an integrated mill.
Wow, that's lean.
And huge emphasis on decentralization. Plant managers had real autonomy, headquarters kept lean, focused on finance and overall strategy. And then the incentives.
Ah, yes, the green is the best motivation idea.
Exactly. Base pay was actually below industry average. But the bonuses tied to group productivity, plant performance, corporate results could be massive. Multiple programs, profit sharing, bonuses, stock options, even college money for employees' kids. The idea was everyone shares in the success.
A powerful motivator, I bet. What else defined their culture?
They actively worked to minimize status differences. Same insurance for everyone, same green jackets on the floor, no reserved parking spots, execs flying coach, modest headquarters. It fostered a sense of teamwork.
And openness to ideas,
Yeah.
risk-taking.
Very much so. Iverson famously said, good managers make bad decisions, meaning it's okay to try things and sometimes fail as long as you learn. Encourage people to speak up, suggest improvements without fear.
A world away from the traditional steel giants, it sounds like. How did this translate into their actual operations?
Well, by '86, they had 16 plants across 10 locations, mostly steelmaking and fabrication. Nucor Steel Division was pumping out bars, angles, light structurals. Their productivity was incredible, second highest in the world, measured by tons per employee.
It's amazing. How'd they do that?
Constant benchmarking, pushing for efficiency. They even let competitors tour their plants sometimes, hoping to learn something in return. And a big chunk of their steel went straight into their own Volcraft joist and deck plants, smart backward integration.
Who bought the rest?
Mostly service centers and distributors. They had a central pricing system, FOB pricing, and it actually stopped giving special discounts to big customers a couple years earlier. Keep it simple and fair.
And their focus on the shop floor workers? How did they manage that so effectively?
It was key. They attracted tons of applicants for jobs, used psychological tests sometimes to find motivated people. Training was intense. Workers learned multiple jobs within their team, trained by experienced peers.
And the pay structure reinforced teamwork.
Definitely. Group bonuses, paid weekly, based on clear metrics posted everywhere, exceed the standard, the whole team benefits, but there were strict rules too. Penalties for being late or missing shifts without good reason.
High expectations, high rewards. Did it lead to loyalty?
Very low turnover rates, remarkably low. And crucially, they had a no-layoff policy. During downturns, they'd cut the work week instead, and everyone, top to bottom, took a pay cut under their Share the Pain program.
Share the pain, that really says something about the culture. What about technology and growth? How did they approach that?
They were relentless investors, constantly putting money back into upgrades and capacity expansion. They kept a close eye on global tech developments. Their R&D was very applied, very hands-on, often right on the factory floor. They saw equipment suppliers as key R&D partners.
And funding these investments.
Their capital budgeting was maybe less formal than the giants, but very disciplined. Key criteria were technical feasibility, return on assets, and making sure they didn't overextend financially, like keeping debt below 30% of capital and not issuing new stock.
And they liked building new plants.
Yeah, often in rural areas, lower costs, maybe non-union labor pools. They frequently acted as their own construction manager to save money and move fast to get plants up and running. Just before this CSP decision, they'd also launched a joint venture with Yamato Kogyo of Japan to make wide flange beams, another move up the value chain.
Okay, so Nucor. Lean, mean, innovative, risk-tolerant, highly productive, great culture. Now they're looking at flat sheet via this unproven thin slab casting. What was the big deal about thin slab? What was the promise?
The promise was, well, revolutionary for steelmaking. The idea was to cast steel much closer to its final thin shape.
Skipping steps.
It's exactly. Potentially reducing or even eliminating a lot of the energy-hungry reheating and heavy rolling needed with traditional thick slabs.
Okay.
People had dreamt about this for ages, Bessemer, way back. But the big technical challenge was always preventing breakouts, basically the molten steel bursting through the thin solidifying shell.
So conventional continuous casting made thicker slabs, like 8–10 inches.
Right, which was a big improvement over old ingots, but still needed lots of rolling. By '86, everyone was researching direct sheet casting, but that seemed decades away. Thin slab casting, making slabs maybe 2 inches thick or less, looked like a potential near-term stepping stone into that flat sheet market.
And there wasn't just one way to do it.
No, different approaches were being tried. One was the Hazlet caster twin belts casting maybe 1-inch slabs. Pilot plants existed, but they had issues.
Like what?
Expensive belts that wore out, lots of downtime, turbulence in the steel affecting quality and causing breakouts, complicated maintenance. Nucor actually sunk about $6 million into trying a Hazlet caster themselves at Darlington, trying to make it work.
So they had firsthand experience with the challenges, and then there was SMS's CSP technology.
Right, compact strip production. It cast slightly thicker slabs, around 2 inches, using this special curved or lens-shaped mold. SMS's pilot plant in Germany was showing promising results, fewer breakouts, lots of industry buzz, but again, nobody had built a full commercial one yet.
So SMS is pitching this to Nucor. What did their proposed commercial plant look like? Scale, cost, benefits?
They were talking a pretty big plant, maybe 800,000 to a million tons a year capacity. Capital cost projected around $300, $400 per ton of capacity. The big sell was the savings.
Where would the savings come from?
Across the board, potentially. In
Hmm.
casting, definitely in rolling, needing fewer rolling stands, maybe 4 instead of 7 to 10.
Well, dr-
Lower labor needs, less energy used, better yield, meaning less wasted steel. The goal was to hit operating costs similar to the best German plants, way below the struggling U.S. integrated mills.
Sounds almost too good to be true. What were the catches? The big uncertainties?
Well, the biggest catch was simply that no one had ever done it commercially. The pilot plant data was based on short runs, like 7 minutes, 12 tons. That doesn't tell you much about long-term wear and tear or maintaining quality consistently day in, day out.
And reliability was key?
Absolutely critical, because the casting and rolling were so tightly linked. Coupled was the term. You needed extremely high uptime, like over 96%, for the economics to work. Any hiccup in casting stopped the whole line. Plus, like all minimills, the economics were sensitive to scrap prices.
Okay, so Iverson and his team are looking at this huge potential, huge unknowns. How did Nucor actually evaluate this potential leap, and what were Iverson's biggest worries?
They'd been tracking thin slab tech since '83 or so. They looked at SMS's early CSP idea back in '84, but thought it was too raw. Then that's when they decided to try the Hazlitt approach instead.
But by early '86, the SMS data looked better.
Much better, apparently. Nucor's COO Bob Aycock and the engineering team visited the German pilot plant and came back very enthusiastic. Iverson was cautiously optimistic, saying something like, "We haven't seen anything that tells us it's not viable," but still cautious.
So they started planning seriously.
Yeah, they did an internal feasibility study for a commercial plant, maybe 1 million tons a year, probably in the Midwest. They even looked into buying a used cold rolling mill to save some capital cost. Their cost estimates were partly based on what they'd learned from the Hazlitt project.
Did they expect a discount from SMS?
They hoped for maybe $10, $20 million off the roughly $90 million price tag for the core machinery, and they wanted performance guarantees built into the deal.
And the total price tag.
Their projection landed around $280 million for the plant itself, taking maybe 2.5 years to build, then another couple of years to ramp up fully, plus about $30 million for startup costs and another $30 million for working capital. That gets you to the $340 million total bet.
How confident were they in those numbers?
They felt okay about the ongoing operating cost projections, less sure about the construction costs, and least confident about nailing those tricky startup costs accurately. They also looked at consultant data comparing costs for this kind of plant versus integrated mills.
So the numbers were crunched, the team was mostly bullish, but Iverson, known for being prudent despite his boldness, still had reservations.
He definitely did. A major one was just the fear of the unknown unknowns, the costs and headaches of being the absolute first to commercialize something this new.
The pioneer tax.
Exactly. Would the first mover advantage really be worth it? Especially since they couldn't get exclusive rights to CSP. Maybe they'd only have a 2-3 year head start before competitors jumped in using the same tech.
And competition could drive up scrap prices.
That was another worry. If lots of minimills adopted CSP, demand for high-quality scrap could soar. Maybe DRI, direct reduced iron, could help, but that was another new factor. Operationally, Iverson knew flat-rolled steel was a different beast than the bars and shapes they were used to making.
Different expertise needed.
Totally. And managing a much bigger, more complex plant, maybe in a rural spot. Could the integrated mills, with their decades of flat-rolled experience, actually learn to use CSP better than Nucor once it was proven? Was a nagging question.
Marketing must have been a big concern, too.
Huge. They felt okay about selling to the construction market and using some internally for Volcraft steel deck, maybe 100,000 tons a year right there. But cracking the high end, appliances, automotive,
Tougher sell.
much tougher.
Yeah.
Those customers demanded top-tier quality, rock-solid delivery of large volumes, and they often bought based on long-term relationships Nucor didn't have yet. But Nucor knew they'd eventually need that high-end market to fill the plant's capacity.
And could they even juggle this massive project alongside other commitments?
That was another major worry for Iverson. They were simultaneously launching that big joint venture with Yamato Kogyo for wide-flange beams. That alone was a strain on money and management time. They needed a lot of capital over the next few years, and interest rates weren't low. Even with $185 million cash on hand, it was a stretch.
And the final nightmare for any tech investor, getting leapfrogged.
Precisely. Iverson was very aware that other, maybe even better technologies were being developed. Mannesmann Damag was working on casting even thinner, 1-inch slabs you could maybe coil right away, and direct sheet casting was still the long-term dream. Was CSP just an interim step? Would its advantage only last 10, 12 years before something better came along? Was that window long enough to justify this enormous bet?
Wow. So you weigh it all up. The chance to revolutionize their business and enter this huge market versus the massive financial exposure, the unproven tech, the operational learning curve, the marketing challenge, the resource strain, and the constant threat of obsolescence. It truly was putting the entire company on the line.
It really encapsulates the toughest kind of strategic decision-making. You have this confluence of market pressure, technological possibility, Nucor's unique strengths, but also very real, potentially fatal risks. Iverson had to balance the allure of transformation against the potential for disaster.
Which brings us right back to that core idea we wanted to explore today. Every strategy definitely has a price. The crucial question is whether it's worth paying.
Yeah.
So thinking about Nucor in late 1986, with all these complex factors swirling around the struggling giants, their own disruptive model, the promise and peril of CSP, what factors would ultimately swing the decision? What would make that $340 million gamble a price worth paying for the chance to completely reshape their future in steel? It's something to really ponder, offering lessons that resonate far beyond just the steel industry.